All right, welcome to The Explainer. Today we're unpacking a really powerful way investors are looking to generate income. It's a strategy that's turning some of the market's most unpredictable stocks into a potential fire hose of cash flow.
For years, it's been a real challenge to find decent yield. Traditional spots, like bonds, just haven't been cutting it, especially with inflation. But what if the key to getting high yield wasn't about playing it safe? What if it was about leaning into risk? Well, a new type of strategy and fund strategy is doing just that.
So get this. Instead of shying away from those big, wild market swings, these new funds are running towards them. The whole idea is to take the crazy price movements of these innovative, fast-moving companies and actually turn them into a steady, predictable stream of income.
And this is a really big deal. It's a fundamental shift from how things used to be done. The old playbook was to sell options on broad, slow and steady indexes like the S&P 500. The new way is much more like surgery. It precisely targets the super high volatility of individual stocks to try and generate way more income.
Okay, so how in the world does this actually work? How do you take something as chaotic as stock volatility and turn it into something that feels like a paycheck? Let's pop the hood and see what's going on.
At the very heart of this whole thing is something called the Volatility Risk Premium, or VRP for short. The easiest way to think about it is like this. Options buyers are often happy to overpay for insurance against big price moves. The VRP is the extra cash you can potentially collect by being the one who sells them that insurance, especially when the market thinks the stock is going to be way more volatile than it actually ends up being.
Now, to really grab that premium, these funds don't just buy up the whole market. No, they're much smarter about it. They focus on a tight, concentrated basket of maybe 20 to 25 innovative companies. This lets them zero in on the unique, company-specific volatility, all that idiosyncratic noise, because that's often where the biggest premiums are hiding.
And right here, you can see what's actually powering these things. And what's cool is you can see the different flavors they come in. You've got the tech-focused funds, FPEI and FGE, holding giants like Apple and NVIDIA. And then there's the crypto equity fund, CEGI, holding names tied to the digital asset world, like Mara Holdings. Same strategy, but as we're about to see, the fuel you put in the engine changes everything.
This brings us to that age-old question every investor has to ask themselves. Do I want more cash in my pocket right now, or do I want more growth potential for the future? It's the classic trade-off, and this strategy gives you a really clear way to make that choice.
Well, these funds give you two very different ways to answer that question. The full coverage model goes all in on income, selling options against every single stock in the portfolio. Then you have the partial coverage model, which only covers half, leaving the other 50% totally free to run if the market suddenly rips higher.
Probably the best way to really get a feel for this trade-off is to put two of these tech funds, FEPI and FEGI, side by side. Now remember, they hold the exact same stocks. The only thing that's different is how much of that portfolio they're using to generate income. Let's see what that does to the numbers. Okay, first up, let's look at FEPI. This one goes all in on income. It uses that 100% coverage model, and wow, look at the result. A massive 27.88% projected annual distribution rate. It's built for pure, maximum cash flow.
All right, now let's check out FEGI. By leaving half of its portfolio uncovered, ready to capture that growth, you're still looking at an incredible 14.02% yield. So you get a really healthy income stream, but you also keep a real stake in the game for that potential upside.
So that gap, that 13.86 percentage point difference between the two, that's it. That's the price you pay for keeping a shot at that growth. It's the amount of right now income an investor is trading for the chance to capture a lot more upside if those tech stocks really take off. It's a choice, and it's crystal clear.
But here's where it gets really interesting. What if you could change the fuel you're putting into this income engine? Because it turns out the kind of volatility you're harvesting makes a massive difference.
Okay, so this is where the plot thickens. Let's bring in our third fund, CEGI. Now, it uses the exact same 50% partial coverage playbook as the tech fund we just saw, but its portfolio is made up of companies from the crypto world, and that one little change has a huge effect.
Just look at this chart. It's kind of stunning, really. CEGI, the crypto fund, with only 50% of its stocks covered, is kicking out a projected yield of 22.55%. That's almost as much as the tech fund that's 100% covered, and it just completely blows away the other 50% tech fund. So what's the big takeaway here? It's that the underlying asset, what you're actually holding, and its own natural volatility is the real engine here.
The insane price swings in the crypto world generate such high option premiums that you can potentially get that max level income while still leaving half of your portfolio totally open for growth. It's pretty wild.
Okay, but of course, with any strategy this powerful, you've got to understand the mechanics, you've got to understand the trade-offs, and most importantly, the risks. So let's get into the fine print.
So to make sure they're not just capping all the potential upside right away, these funds use a pretty clever trick. They sell their options out of the money, which is just a fancy way of saying they set the target price about 10% higher than where the stock is trading right now. This creates a built-in 10% growth buffer, like a cushion for the stocks to go up before that cap even kicks in.
And this table really shows you why that combo, the 10% buffer plus only 50% coverage, can be so powerful. If the market has a huge rally, way more than 10%, the fully covered fund is capped. But those partially covered funds, they've still got half their portfolio totally unchained, ready to capture all of that extra upside. That could lead to way higher total returns.
But, and this is super important to remember, you have to know where these strategies don't work so well. They're built for choppy, sideways, or kind of moderately rising markets. If you get a monster bull market that just goes straight up, what they call a vertical market, these strategies are going to lag because their gains are, by design, capped.
And of course, you absolutely have to understand the risks. First things first, the value of the stocks themselves can go down. Your capital is at risk. And second, and this is a big one, those huge distribution rates we've been looking at, they're projections. They're based on what's happened in the past. They are absolutely not a guarantee of future income.
So this leaves us with one last big question to chew on. As the old ways of getting income seem to be drying up, are we looking at a fundamental shift here? Could harnessing the raw, inherent volatility of the world's biggest innovators be the new playbook for income for years to come?